Alright, howdy guys, and welcome to the next video, introductions to the statement of cash flows as well as some other financial statements that we'll mention. In this video we will discuss the major sections of the statement of cash flows as opposed to the video on the income statement of the balance sheet. We went into depth into the elements. We'll just talk about the major section of the statement of cash flows. We'll spend some time talking about why profit does not equal cash flows. We'll also talk about other financial statements. In particular, we want to spend some time on the P&L, or what some people might refer to as a branch level or the division level income statement. The statement of cash flow provides a more detailed explanation of the source and uses of cash. In the end of the day, cash is king. We don't pay rent with metrics or anything else. We pay rent with dollars. So we want to have an idea of what's going on with cash flows. The interesting thing about the statement of cash flows is it can actually be recreated for the most part if you have a copy of the income statement and the balance sheet. So you can get most of the elements of the statement of cash flows off of those two documents, or at least the difference between one year and the next. However, because cash flows is as important as it is, the statement of cash flows is an important financial document. It's similar to the income statement in the fact that it covers a period of time as opposed to the balance sheet covering being a point in time. The three major categories we'll discuss are operating activities, investing activities, and financing activities. So here is an example of a statement of cash flows. The first section here is net cash provided by operating activities. Operating activities are activities or impacts of net earnings and daily decisions on cash flow. For example, if the amount invested in inventory increases, then cash provided by operating activities will be less than net earnings if everything else is equal. So anything that impacts net earnings, anything to do with increasing accounts receivable, inventory, prepaid expenses, accounts payable, taxes payable, similar things such as this, has an impact on net cash provided by operating activities. Investing activities, impacts on capital purchases on cash flows. So for example, if the amount invested in equipment increases, then cash provided by investing activities will be less if everything else is equal. Financing activities are the results of impacts of financial decisions on cash flow. So for example, if cash is used to pay down debt or in the form of dividends to the owners, there will be less cash available for the business. Cash at the end of the period is simply the cash at the beginning of the period plus the net increase in cash over the period. It will also be the cash at the beginning of the next period. So you've got to remember, whatever cash you end with, let's just say on December 31st of a particular year, will be the same cash you open the doors with on January 1 of the following year. So basically it's with the very next day. So the question comes up, why does profit not equal cash flow? To answer that question, we'll look at the sources and uses of cash within a business, or at least examples of each of those. We'll start with sources of cash. A decrease in an asset account or an increase in the liability or equity account will produce cash. So I'll give you some examples. Let's look at operating examples. If we're able to decrease inventory, that increases cash available to the business. A decrease in accounts receivable, in other words, we collect from our customers sooner, not necessarily sell less, but collect from our customers sooner, will increase the amount of cash available to the business. And also an increase in accounts payable. So if we can negotiate longer payment terms with our vendors or buy from vendors that give us the better payment terms, that will free up more cash in the business. When it comes to inventory, there was inventory guru in the 1980s that was real famous. He used to say you really couldn't measure or couldn't manage inventory properly if you couldn't see the cash. And so when you walk out in the warehouse, you just see cash tied up in all the inventory. It may be a very good investment in that cash, because you need inventory to service your customers. And again, as we've said in other videos, it's a high expectation that of the supply chain members that the distributor be very good at managing inventory and have inventory needed in the local markets. But it is cash, and if we can decrease that inventory, it increases cash. Other sources of cash, for example, from investing examples, selling equipment. If you have equipment that's not needed, you sell that equipment, that increases cash. Selling property could also increase cash. So anything with property, plant, and equipment, if we can use less of that, it'll increase cash. Financing examples include receiving a loan. So if we get a loan, that increases the amount of cash available on the balance sheet. Or receiving money from shareholders. On the flip side, or the reverse of that, is the uses of cash, and it basically is that. An increase in an asset account consumes cash. A decrease in a liability or equity account consumes cash. So operating examples, an increase in inventory will consume cash. An increase in accounts receivable, so if customers start paying us later, will consume cash. A decrease in accounts payable consumes cash. Investing examples include buying equipment or buying property. Financing examples include paying down a loan or paying money to shareholders in the form of dividend or return of capital. Depreciation has an impact on the difference between net income and cash flow as well. So what is depreciation? Depreciation is the recognition of the reduction of value of a long-term asset as it is used in the business. So for example, if you buy a forklift and let's say that you paid $60,000 for the forklift and you're going to use it for 5 years, and you expect at the end of 5 years that you'd be able to sell the forklift for $10,000 because you're going to get a lot of use out of it, and over time some things tend to lose value. So you're going to buy it for $60,000, you're going to sell it for $10,000. So that is a reduction in the value of that asset over the 5 years of $50,000. So if you're doing straight line depreciation, you would take an expense each year of $10,000 to recognize the reduction of that asset. That would be proper accounting. It would not be proper accounting just to wait till you got to the end of 5 years, sell it, and then take a $50,000 loss. You would take the loss over the life of the asset. Depreciation is an expense on the income statement, and it reduces the value of an asset on the balance sheet. However, it's not a cash flow. In fact, it may even be considered a positive cash flow because as we recognize this expense, it lowers our taxes owed, and so kind of since it's lowering our taxes, in essence, we get to pay less in taxes, so our cash flow may go up from that. Amortization is similar but for intangible assets. Think about depreciation or things that you depreciate things you can touch and feel. You amortize things that you cannot, like patents and trademarks, or the expense of getting patents and trademarks and similar items. Another impact to cash flow that makes there be a difference between net income and cash flow is inventory costing. So whether you're using FIFO, LIFO, average cost, specific identification, whatever the methodology may be that you're using, can have an impact on net income that's different than the impact on cash flow. So that's kind of an overview of the statement of cash flows. Remember, cash is king. It covers a period of time similar to the income statement. 3 major categories are operating activities, which includes things like net earnings, inventory management, accounts receivable management, accounts payable management. Investing activities, the second category there, includes things such that we invest in, like property, plant, and equipment. And then financing activities has to do with getting money from shareholders, paying money to shareholders, or getting money from creditors or paying money to creditors. And what's important for managers to remember is that cash generated by operating activities can be used for other activities such as acquisitions or paying down debt. Some other financial statements that are important to know that we won't go into details of are things like the statement of retained earnings, which provides more detail on how the earnings of the company are treated. You also have the statement of stockholders' equity, which gives a better description of where the book value of the equity resulted. And finally, there's the notes to the financial statement. The notes provide details about how the numbers in the financial statement were determined. The P&L, or the branch level income statement, is important to talk about here as well. While this isn't necessarily something that you would find in published financials, it's something more of an internal document that we'll talk about more in the financial management videos. But while we're talking about financial statements, it makes sense to mention here and talk about the differences. So it basically is the statement of profit and loss. And if you ask some accountants, they may tell you that it is actually the same as the income statement. And the truth is, it's similar in form to, and the actual definition may be the same as the income statement. But the way I see it used in industry is it's commonly used to describe a managerial tool that combines financial metrics from both the income statement and the balance sheet to reflect the profitability of a given operation for a given period. It's typically used to give the manager of an operation, whether that be a branch or division manager or area manager, the necessary information to make decisions about the operation. Generally, it's an internal document that is not audited or presented to outsiders for investing considerations. Therefore, it may contain information that does not comply with generally accepted accounting principles. Typically, it has a lot more detail to it. It might break down how much specifically you're spending on warehouse employees or sales employees or entertainment expense, where all those expenses would be lumped together in your published income statement. You wouldn't provide that level of detail, but you need that level of detail to perform your duties as a manager. And that is the end of the introduction to the statement of cash flows and the other financial statements.